Where did you grow up and how did you find your way to the financial markets?
I grew up in Alabama and I went up east to school. I went to Columbia for a year and transferred to Yale. And I didn't know anything about finance. And I was studying English literature mainly. And my senior year in college, I realized I didn't know what I was going to do with my life. And I looked at grad school in English, and that didn't look very promising. And my college roommate was a football player, and he was graduating a semester ahead of me. And he worked in the S&P pits in Chicago at the Mercantile Exchange. He worked for Kidder Peabody. He's about 6'5", 230, which was a good attribute to have in those days. And he turned to me and he literally said, Daniel, what are you doing? You got to be a trader. You can be out by 1:30 in the afternoon on the golf course by 3, and you can make 100 grand when you're 25. And I looked at him and I said, Andy, I don't know what a trader does, but I can do that. And that was literally the first time I really gave it thought. I'd had one economics class, I'd had some math, but that was it. And I remember I got a second interview with O'Connor. All the Wall Street firms didn't much think they didn't like me because I didn't have any classes in this. I had no experience. But O'Connor had the attitude that they didn't like you taking classes and they wanted to train you themselves, which was a lucky break for me. I was on spring break and I was rowing for Yale at the time, and I had to take a bus ride from Tampa back to New Haven. And it was about I don't know, 20-hour ride. And O'Connor had sent me the Option Clearing Corp, a little brochure on options, which I didn't know what they were. And I read the thing like 10 times. And so when I made it to my second interview, lo and behold, I knew what an option was, at least enough to get through an interview, and they hired me. But literally, that's what happened. They sent me to Philadelphia. I was a nervous wreck for 3 months and as a clerk in the trading pits. And then after a few months after that, it all started to click.
What was the PHLX environment like, particularly for someone from Alabama?
In some ways, it was probably friendlier than Chicago because it just wasn't as big. But on the other hand, it was very Philadelphia, and yeah, it was a bit odd to have a kid from Alabama. But at the time, O'Connor had a lot of capital, and I had like people looking out for me. So at the age of 23, when I was trading, I had a guy named Jay DeVoli who ran the office, helping me stay out of trouble and keeping people from being too rough on me. But it was fun. It was a great place to learn because there's a lot of mid-cap stocks and being taken over. Jeff Yaz was in the same pits as me sometimes, and it was a great place to meet people. And I learned a lot about life. I would say this: there were people on there that didn't graduate college, and there are people down there with PhDs, and it was not always clear who the better trader was. And it was a great experience for me.
How did you find your way to Chicago?
After about 3.5 years in Philadelphia, I persuaded them to let me go to Chicago because I wanted to get an MBA because I didn't know enough. I was an English major and that was great, but I hadn't had statistics. I really didn't understand Black-Scholes as well as I'd like to. And they accommodated me and they sent me to a desk that helped monitor the traders on the Philly and Amex. And I got my MBA at the University of Chicago in the early 90s. I got shifted to convertible bonds, which were terrific because they were bonds with options inside of them. And I used to tell people, and I'm sure it's changed now, but at the time, the smartest people and the dumbest people on Wall Street traded convertible bonds. So it was a great combination. And some of the people we traded against included Ken Griffin at Citadel, which was called Taft then, and there's a lot of really talented people that went on to create large hedge funds. And then there were other people that didn't understand the present value of money trading them. So it was a great product. I worked for a guy named Joe Scobie, who's still, I would say, a good friend of mine. But behind the scenes, O'Connor had done a joint venture with Swiss Bank, and then Swiss Bank decided to buy them. And then Swiss Bank bought SG Warburg. And before I knew it, I was working for an investment bank, and I got sent to New York to start a client trading business for SBC Warburg in 1996. And that was interesting, but it was very different. And it was was just very different. It was all of a sudden I went from being a Chicago trading firm, which I to this day think is the best kind of organization to be in, to a client-facing firm as part of a big bank. And I had a good time building a business, and I learned a lot, but it was pretty different.
What was the impact of working with the Swiss bank on O'Connor?
When Swiss Bank and O'Connor did their joint venture, it was awesome, especially for the partners and the people at the next level. And I was one level below that, because all of a sudden they had all this opportunity we didn't have at O'Connor, because we didn't have the balance sheet, we didn't have clients, especially in FX and interest rates. Equities, which I was an equity trader, equity option trader, convertible bond trader. There was still Glass-Steagall, so it was still kind of a hodgepodge for us in Chicago and at the beginning in New York until Glass-Steagall kind of came down. But for many people, it was a huge opportunity. But about the time we started really building a bigger business in New York, and right before we moved to this huge trading floor in Stamford, I think a lot of people left. And when we wanted people to leave Chicago, some people decided, I don't want to leave Chicago, I want to stay here. Or they decided, like, well, if I'm going to New York, this isn't quite O'Connor anymore, and I might as well look around. And at one point in time, when I was global head of equities with John Wall at UBS, which was a great business, and John Wall was an O'Connor trader from London, the head of equities at Morgan Stanley was Fabrizio Gallo, O'Connor trader. The head of equities at Credit Suisse was Bobby Jane, was an O'Connor equities trader. And then Ralph Reynolds, who was one of my bosses at O'Connor, was running Deutsche Bank. So O'Connor really was a great place to train, and a lot of people saw the opportunities when they left, and a lot of these investment banks wanted O'Connor guys because of risk management and understanding options and other things that they didn't at that time have a great understanding of. So things really did change in the mid 90s, from like 95 to 98, 99. And by that time, it was a very different place. The Swiss Bank closed the deal on Warburg. Then they bought this bank called Dillon Reed. And then the next thing you know, UBS and Swiss Bank merged. And all that happened in like 2 years. And so my head was spinning by the end of that. But it was fun because we didn't really have a big client business in the US, and we kind of got to create it from scratch. And then in 2000, we bought Payne Weber. And then we really, at that point, started to have a pretty big business.
What did it mean to be head of equities for UBS?
It was a great business at UBS. Warburg had a great traditional business, a great research department, and they had people all over the world. And I don't mean just Hong Kong. They had people in Indonesia. They had people everywhere, which gave our research department just incredible information, and clients really valued that. Then you had the sort of SBC O'Connor derivative business, which was a great business now that we had this huge global platform, both for corporations and for institutions. Then you had the private bank, and you had Payne Weber, who needed structured products, which also fit in our derivative business, and that was incredible business. And in those days, we had probably the largest prop business, larger than Goldman Sachs. Some of it, a lot of it were ex-O'Connor people, but there were other people that we'd hired around the world. And it was also a terrific business. And then we gradually cobbled together some prime brokerage businesses. We bought ABN's prime brokerage, Payne Weber's prime brokerage, and invested a lot. And we, at one point, had a top two, I think, futures clearing business. We bought ABN's business there as well. So around 2007, it was just a terrific business. We had about 4,000 people. In US GAAP terms, we probably had about 10 billion in revenue, and we were probably one or two on the street. And then in 2008, our fixed income department proceeded to lose $50 billion over a couple of years, and it wasn't so good anymore. But in any case, the equities business was fun. We had a lot of great people. And for about 3 or 4 years there was probably, in some ways, the best years of my career, that and the O'Connor days.
How did you find your way from UBS to GetCo?
As UBS basically was having all kinds of problems. The private bank had gotten in trouble with the U.S. government. Our fixed income department was a mess. and we started. We had capital issues. I was up to be CEO of the investment bank, and I didn't get it, which was probably a blessing. But that definitely was a blessing in many ways. And they brought in someone who I didn't think was the right person. He lasted a year, and then the bank got a new CEO who I didn't think was that terrific, and he put two other people in charge of the investment bank. And at that time, I just realized, I'm going to do what I can to stabilize things because I care a lot about the people I work with, but I got to leave. And so I finished out 2009, made sure the equities business got a bonus pool. And then I just said, I've had as much fun in banking as I care to have. Now, in December of 2008, I met with General Atlantic, and I was actually pitching them on behalf of UBS. And they said they wanted to talk to me about something else. And they did talk to me about Getco. That was one of their big investments. It was a good investment for them. And the founders of Getco, Dan Tierney and Steve Schuler, great guys, not really interested in management. And they were looking for someone to eventually run the firm. And it was a great conversation. Then I met Dan and Steve later that year, and I'm like, these guys are having fun, and everyone in investment banks are miserable, including me. I realized it was time for me to leave. And in some ways, Getco reminded me a little bit of O'Connor. In some ways, it was pretty different. But when I did leave and I started Getco in the fall of 2010, it had some of the same office space as O'Connor. It had 300 people. That was the size of O'Connor when I joined. And I just knew that it was the right time for me to go back to a Chicago trading firm.
What are the similarities between Getco and O'Connor?
One difference is I was coming at Getco at a very high level, and O'Connor I was coming at a low level, so my observation might be a little off. But I know at Getco, when I first looked at my contract, I wasn't even allowed to tell people I worked at Getco. And I told the guys, that's kind of silly, don't you think? And they're like, yeah, don't worry about it. But they're very secretive because they had some special sauce that was really good and was making them a lot of money. At the same time, the Getco guys, it was a different environment because pretty much everyone could program, and everyone could program in ways that's how they communicated with each other. And so unless you knew what you were looking for, it'd be pretty hard to figure out what information you really wanted. You did have conversations by the water cooler, but it was a different environment in a different time. But the sense that, hey, it's our firm, it's our money, it's our intellectual property, you need to respect that. That was loud and clear at both Getco and O'Connor. Now, as a junior guy at O'Connor, you always felt like you're about to get fired. I mean, I remember just like we call these things called pilgrims. I don't know why we called them that, but they were your theoretical value sheets. They were just printouts of Black-Scholes with basic information that I think today is not a proprietary, but even then I'm not even sure how proprietary it was. But we were taught we were the only people in the world that had ever heard of Black-Scholes, and if we left those lying around, that was the end of it for us. And we were scared to death to leave those lying around because someone's going to grab a piece of paper and figure out how our put option model worked differently than theirs. But we were convinced it was going to happen, and we were really careful. So I'll say as a junior person, that environment can be a bit intimidating, but I do appreciate it in that with a trading firm, it's the partner's money, it's partner's IP, and you need to respect it.
What was Getco's performance like in the marketplace?
Sometimes it's hard to know exactly how you make money. And I think it's really important to know exactly how you make money. Is it because of speed? Is it because of my models? Is it because of whatever reason? I just need to know because I need to build on it and protect it. And I think speed was probably more important than Getco realized. But had some super talented people that did lots of different things. But I think when I showed up, that was literally the day that I think Getco no longer was really unbeatable in the U.S. equity markets. And in those days, Getco had like 20+% market share. I mean, it was crazy in a lot of stocks. So So that's one piece of information I think is okay. I can share now. It's been a long time. Um, like any high frequency trading firm, you don't need a lot of capital, and so the ROE is terrific. And and I think there's always the temptation to say, well, let's take these profits and invest them in other things, and it's the right thing to do in many ways. But nothing's quite like high frequency in it. And I think it's always really important to reinvest in the core business of something that yields that kind of ROEs. Uh, my job at Gecko, besides being sort of management, and they made me CEO about a year later, was really to try to look at adjacent businesses and leverage our technology. And it was harder than I expected. And it was because the technology had been so fine-tuned to the Gecko trade that once you start doing other trades, like some arbitrage trades, like at the time ADRs or ETFs, you really had to de-optimize and really and do things that we weren't doing. Gecko was particularly good at optimizing processes. Its back office was incredibly efficient. And when you start doing messy trades like arbitrage, you really have to look at every piece of the process and try to de-optimize it, unfortunately. So that was a bigger challenge than I imagined.
What was attractive to Gecko about Knight to form the KCG deal?
Knight had a very good market making business that made markets to retail, and that's a very complicated business. And what I mean by that is it's complicated with respect to client management. It's risky in that part of the reason these internalizers exist is they take on the liability of the trade where an exchange would not do that. So that was an interesting business to us. And there's some other businesses that we thought were pretty interesting. So that's from a strategic point of view is a reason. From the other points of view is we invested in Knight at the equivalent of $4.50 a share in August of 2012. And we sold Knight in August of 2017 at $20 a share. And so it was a situation where we were part of a group that was led by Jefferies to invest in Knight to recapitalize it. And it was either going to go under or it was going to have the capital and go up a fair amount. And so it did go up, and then we bought it, and then we basically doubled the stock price in about 4 years. Knight had a lot of assets that weren't very good, and we tried to streamline it and take a lot of costs out, and had businesses that weren't great culture fits for us. And it had a reverse mortgage business. Robert Wagner was on the payroll. If you've ever seen him sell reverse mortgages, we had a rule. I had a rule: if you advertise after 11 p.m., you shouldn't be in that business. So in any case, we got rid of those. We streamed it down, and then our largest shareholder at the time, Jefferies, had conversations with Virtu about potentially buying us. And Virtu paid a good price, but I really felt like if we'd had 2 more years, we could have done something very special there. But in any case, it worked out for shareholders. But I don't think we ever really realized the potential. And I'll say one more thing, a step back. My experience at UBS during the financial crisis led me to believe there had to be a role for larger for trading firms that weren't banks, kind of pre-Glass-Steagall, that could really focus and automate and really make a difference in financial markets. And I really believe that. I met with all the regulators. They were so mad at the banks, and I was like, no way they would let them keep these businesses. I was wrong. They did. But to some extent, the strategic view was we were going to be one of those firms. We were going to trade everything from treasuries to other kinds of fixed income to FX. We were going to use the technology that Knight had and that Gecko had, and we were going to be lean from a capital point of view. And we were going to be one of these firms that would take advantage of this opportunity. But I just feel like inertia set in, and that the handful of banks that were successful just got more successful, and this transition to trading firms just never happened.
How long did you stay at KCG, And what did you do to grow that business?
We bought an asset that was damaged, and it wasn't very efficient. So we spent several years selling off pieces and returning capital to shareholders, paying down debt. We probably bought back a third of our shares, just getting leaner and focusing on the businesses that we wanted to be in. And that's why, I wish we'd had a couple more years, because I just felt like we just gotten where we wanted to be. Mainly was about kind of streamlining and making sure we're really good at everything we did, making sure our businesses had good returns on equity, and making sure they made sense for us to have with our clients.
Were the owners of Getco looking for an exit strategy?
I'm not sure they were necessarily looking for an exit strategy from a monetary point of view, but I think they were looking to do other things, and they've done lots of different things since. So to some extent, this deal suited them. One can argue if Getco just stayed Getco and focused on on what it was good at and didn't go into the client businesses, where would it be today, and how successful would it be? And it's hard to say. I can tell you that going back to Jane Street, I don't think they were bigger than Getco when we were competing with them. I thought they were very good. I liked the guys there, but I don't think they were any bigger revenue-wise, even, or as big as us revenue-wise. And so they've done phenomenally well. Others have done phenomenally well. People who left Getco have done really well. So it's hard to say if they should have, we at Getco, because I was running it then, should have just stayed Getco and not done that. But at the time, it really seemed like a great opportunity, and the financing of it was priced right. So we went for it.
Did you leave after KCG was bought by Virtu?
That was my exit. Yeah. Yeah. So Virtu had different philosophies. They're very much lean and mean for sure. And they didn't have ambitions to do some of the things we were doing. So they shrunk a lot of things there. And Doug Sifu was CEO. I knew he was going to be CEO of the new company. So there wasn't no misunderstandings there by any means. And when I was at Getco and KCG, I was living in Birmingham then. I moved home in 2009. And so I was commuting every week, getting up early Monday, trying to fly home Thursday night. And it was wearing on me personally and physically. And while I would have financially and otherwise would have liked another 2 to 3 years at KCG, I was also ready to stop. And I think that my oldest daughter was her last year before she went to college, and I had 2 other kids that were younger, and it was time for me to do something different and slow down. I'd been on Wall Street for 31 years, and I was ready to really come home. And so that's when we sold it and signed on I had to hang out until the deal closed. But once the deal closed, I was gone.
What do you miss about trading?
I miss the clarity of it. I miss the thrill of it. I miss trying to be in tune with all information in the world at the same time. I miss arguing with people next to me about a trade. I miss it all. And even when I went into management, I miss the actual trading. But being in a trading firm is close, and the relevance of all information to what you're doing, I think, is exciting. I think the idea of trying the competition and the immediate results is very appealing to me. I might not have realized this when I was 21, but I can tell you today, it's much more suited to my personality than academia. And so I do miss it a lot, and I miss the people a lot. The people in trading are smart, and they're very smart. And KCG had more PhDs than most colleges, but I don't even mean the PhDs. I mean the traders. I really miss that, and I miss having people not shy away from an argument. I do miss it a lot. I can't say I'm going to turn 60 this year, so I don't see myself going back into trading per se. I don't know if I have the energy, but I do miss it, and I miss a lot of the people in it.